I'm going to show you why silver is going to $100 per ounce. Not because of manipulation, not because of a retail squeeze, not because banks are going to cover shorts or paper markets are going to break, because of arithmetic. Simple, undeniable arithmetic that nobody, not the skeptics, not the bears, not the people who've been calling silver a bad investment for 20 years, can argue with. The numbers are public. The data is verified. The conclusion is unavoidable. Silver supply cannot meet silver demand at current prices, and when supply cannot meet demand, price rises until it does. That's not speculation, that's economics. Let's go through the math together. Start with supply. Global silver mine production in 2025 was approximately 835 million ounces. That's new silver coming out of the ground. Add recycling. About 200 million ounces per year comes from scrap, old jewelry, industrial waste, electronics recycling. Total supply, 1,035 million ounces. That number has been essentially flat for 10 years. It's not growing. Why? Because 70% of silver comes as a byproduct of copper, zinc, lead, and gold mining. When those metals prices don't support new mine development, silver supply doesn't grow either. And even when silver prices rise, it takes 7 to 10 years to bring a new mine online. We covered this in a previous video. The permitting, the infrastructure, the community opposition, all of it adds time and cost. So supply is essentially fixed in the near term. Best case, it grows 2 or 3% annually. More likely, it stays flat or even declines as older mines deplete. That's the supply side. Now demand. Industrial demand in 2025 was approximately 600 million ounces. Let me break that down by sector. Solar panels, 130 million ounces. Solar installations are growing at 15 to 20% annually. Every panel needs silver paste for the photovoltaic cells. No viable substitute exists at scale. Electronics and semiconductors, 90 million ounces. This includes traditional electronics plus the new AI chip demand we've discussed. AI chips use 3 times more silver than conventional chips, and AI infrastructure deployment is accelerating. Electric vehicles, 40 million ounces. EVs use 2 to 3 times more silver than internal combustion vehicles. Every charging station uses silver. Global EV sales are growing 25% annually. 5G infrastructure, 30 million ounces. The build-out continues globally. Every base station, every antenna, every connection point uses silver for its conductivity properties. Medical applications, RFID tags, water purification, batteries, mirrors, and hundreds of other industrial uses. 310 million ounces combined. Total industrial demand, 600 million ounces. And it's growing 8 to 12% per year depending on which sectors accelerate fastest. Now add investment demand. Physical investment demand, coins, bars, allocated storage, was approximately 250 million ounces in 2025. This includes retail stackers, small institutions, family offices, anyone buying physical silver and holding it. ETF demand was another 50 million ounces as funds like PSLV and SLV saw inflows. Jewelry and silverware, 80 million ounces. Relatively stable, doesn't grow or shrink dramatically year to year. Total demand across all categories, 980 million ounces. Wait, supply is 1,035 million. Demand is 980 million. That's a 55 million ounce surplus, right? Wrong. Because I haven't included the demand that's about to hit the market and has no historical precedent. Central bank and sovereign buying. Up until 2024, central banks barely touched silver. They bought gold. Silver was seen as too volatile, too industrial, not monetary enough. That's changing. Multiple central banks in Asia and the Middle East are now including silver in reserve diversification strategies. Not in the quantities they buy gold, but in meaningful amounts. If central banks allocate even 2% of their gold buying budget to silver, that's an additional 40 million ounces of annual demand. Sovereign wealth funds are doing the same. They're recognizing that silver has dual character, monetary and industrial, which makes it a hedge against both currency debasement and industrial commodity shortages. Add another 30 million ounces from sovereign wealth fund allocations. Now we're at 1,050 million ounces of total demand against 1,035 million ounces of supply, a deficit of 15 million ounces in 2025. But that's just the beginning. Let's project forward to 2027 and 2028 using conservative growth rates. Industrial demand growing at 10% annually, solar accelerating, AI chips ramping, EVs scaling. By 2027, industrial demand hits 730 million ounces. Investment demand growing at 8% annually, more retail stackers, more institutions recognizing the thesis, more sovereign buyers. By 2027, investment demand hits 330 million ounces. Jewelry stable at 80 million. Total 2027 demand, 1,140 million ounces. Supply growing at 2% annually, optimistic given mine depletion and permitting challenges. By 2027, supply hits 1,075 million ounces. Deficit in 2027, 65 million ounces. By 2028, if trends continue, the deficit reaches 100 million ounces annually. That's not a typo. 100 million ounces per year of demand that cannot be satisfied by current production. Where does that silver come from? It comes from existing stockpiles, COMEX inventories, ETF holdings, government reserves, private hoards, above-ground silver that's been sitting in vaults, waiting. But here's the problem. Those stockpiles are finite, and they're shrinking. COMEX registered silver, the metal available for delivery against futures contracts, has dropped from 180 million ounces in 2020 to under 70 million today. ETF inventories have been drawn down as physical demand exceeds inflows. Government stockpiles in the US were sold off in the early 2000s. The strategic stockpile is essentially gone. Private holdings are the largest pool, but they're not for sale at current prices. These are stackers who've been accumulating for years or decades. They're not selling at $30. They're waiting for the repricing. So the available float, the silver that can actually be purchased and delivered at current prices, is much smaller than total above-ground stocks suggest. At a 100 million ounce annual deficit, the available float gets exhausted in 2 to 3 years. Then what? Then price rises until one of two things happens. Either demand is destroyed, industrial users stop using silver because it's too expensive. But we've established there are no substitutes for most applications. Solar panels need silver. AI chips need silver. You can't build them without it. Or supply increases. Miners open new mines, increase production, recycling ramps up. But we've established that takes 7 to 10 years for new supply, and recycling is already maxed out. So neither demand destruction nor supply response can happen quickly enough to close a 100 million ounce annual deficit. That leaves only one mechanism. Price rises until marginal demand is rationed and every possible ounce of supply is incentivized into the market. What price does that? I don't know exactly. Nobody does. But we can make educated estimates based on historical precedent. In 2011, when silver hit $49, industrial users were paying it. They complained, but they paid. The applications that required silver got the silver. Adjusted for inflation, $49 in 2011 is about $65 today, but the deficit we're facing now is larger than 2011. The industrial demand is more locked in. The supply is more constrained. $100 is not unreasonable. It might even be conservative. Here's what this means for you. Stop waiting for a squeeze. Stop watching COMEX inventories hoping for a delivery default. Stop obsessing over whether the banks are going to cover. Just look at the math. Demand exceeds supply. The deficit is growing. The available float is finite. Price must rise to equilibrium. That's not manipulation theory. That's supply and demand. You position by buying physical silver now while the market still prices it like the deficit doesn't exist. You hold through volatility because the path to 100 won't be smooth. And you ignore the noise, the manipulation headlines, the squeeze narratives, the conspiracy theories. The math is enough. 200 million ounce deficit by 2028. Finite stockpiles, no substitutes. 7 to 10 year supply response time. Price goes higher. Not because we squeezed anyone, because arithmetic required it. Stack accordingly.